Welcome to the PIWORLD Thursday webinar on the 7th of May 2020. And I'm your host, Tamsin Freeman. Today, I'm delighted to be joined by Keith Ashworth-Lord, who is Chief Investment Officer at Sanford Deland Buffettology Fund, and he's going to outline his COVID-19 survival strategy. Keith, many thanks for joining us. For those who don't know you, give us a short overview of your background and the Buffettology Fund.
Okay, well, I came into this industry right back in the early 1980s, right into the teeth of a bear market, actually. And I'd been messing around. I was an analyst. I became a head of research. And to be honest, after about 10 or 15 years in the industry, I'd not learned a damn thing. I'd learned how to trade stocks. I'd learned about stockbroking, but as regards what we would really call investment, I really wasn't off home base. And I started doing an awful lot of reading. It led me to, first of all, Benjamin Graham and The Intelligent Investor. That was the first thing that really registered with me. And the thing that got me was this group of investors collectively called the Super Investors of Graham and Doddsville, which included people like Bill Ruane and Walter Schloss and, of course, Warren Buffett. And the thing that got me about it was these guys were all beating the S&P year in, year out with very different portfolios. And the only thing seemed to be that Ben Graham was true north on their investment compasses. So that kind of got me interested. And from that, I started to read and look at what Buffett was doing. From Buffett, I got to Munger. From Munger, I got back to Philip Fisher. And I started to really absorb all this whole business perspective investing philosophy. As a result of that, my then business colleague, Jeremy Otten, we had a publication called Analyst in those days. We started going out to Omaha, to the Berkshire AGMs, and we got to know that whole group of people who collectively are known as the Buffettologists. We also got a 2-on-2 with Warren and Charlie, I might add. Only lasted about 15, 20 minutes, but it's good bragging rights. And as a result of those liaisons, I was approached by David Clark and Mary Buffett in 2009 as to whether I would like to set up a fund along the principles of Buffettology. Buffettology was the book, incidentally, that the two of them wrote about how Warren Buffett goes about his investments. It was written from an insider's view in the sense that Mary was married to Peter, Warren's youngest child, and Dave was dating Susie, Warren's eldest child at the time. So that's how they knew one another. Anyway, the upshot is we agreed terms for the exclusive license of the trademark Buffettology to use on the fund. We set the company up, Sanford Deland Asset Management, in 2010. We launched the fund in March 2011. And here we are 9 years down the track with a fund in excess of 1.2 billion. I never really thought it would take off quite like that. That's probably the surprise of the whole thing. In terms of performance, it's been very good, but then again, I never expected it would be anything other than that. I've been using this method of investing since the mid-90s. It's always done very well for me. There's no reason at all why it shouldn't work on a bigger canvas. So that's kind of the background. Sanford Deland has got another fund called Free Spirit, a much smaller fund, which is probably like Buff was 5 years ago. And we've got a great little group of people, very, very small group, half a dozen people, but all absolutely on these tram tracks.
Well, your investing return has been amazing. You've got 200% return or around there since launching the fund in 2011. And last year in 2019, it was 25.25% return. So this year, challenging markets, how have you fared?
Well, for 2020 year to date, we're currently down by 17.3%, and that's against the market as measured by the FTSE All Share Index. It's down 23.2%. So we're down, but we're not down as bad as the market. So, and the ROI from launch as at last night is 190%. The fund share price is a little over 290 pence.
So shareholders that have been in since the beginning can't complain. So with COVID-19, when did you perceive it was going to hit the markets, and did you do anything to prepare for it?
I'm not going to tell a lie. I did not imagine it would have quite the effect it has until fairly late on. And the change factor for me was the draconian nature of the lockdown and the way in which the government was prepared to crash the economy to stop the spread of this disease. I really did not expect such measures in a liberal democracy. It really did surprise me, and perhaps even more what surprised me is the way people seem to have accepted it, albeit it's wearing a little thin at the moment. So I was very late into thinking this could really have a nasty impact on markets. I didn't have any crystal ball or foresight, so a bit behind the curve, I think.
So what was your cash level when you went into it?
Well, at the end of February, we held 12% of actually bang on 12% of the net asset value was in cash. And last night that was down to 10.3%.
And do you think that this bear market is any different to any others? And has it caused you to act differently?
I think all bear markets are different in that the catalyst is different, but the way they play out is usually the same in a sort of an investment psychology sense. I think the difference this time is that we haven't really seen a capitulation phase, which traditionally marks the turning point of the bear market. I don't think we were at a capitulation phase on March the 23rd when we hit the nadir. We might have another downswing and a capitulation phase yet to come. I mean, who knows?
Mm. And did it cause you to sell any holdings because it had changed the business model for any of your holdings?
It's a good question, that actually. Very on the mark. I would say that my thinking on businesses that directly face the consumer was already formed, and it's been augmented by this lockdown and its impact. I was becoming wary of the sort of fad and fashion element that pertains in retail and the hospitality sectors. For me, once it became apparent that a lot of businesses were going to have to do without any customers for an extended period of time, it became a question of, well, who will survive this? So we in the fund, we'd already been quietly clearing out our holdings in the retail and travel and leisure sectors really since last year. And we just accelerated that. And in fact, as currently constituted, the portfolio has zero exposure to retail, and it only holds Dark Group in the travel and leisure sector. I think Dark Group, Jet2 and Jet2 Holidays will be a survivor. I think others won't, and that should, in theory, confirm more pricing power for Dart when we get out of this. So in terms of what's gone, we sold our stake in Next in early April. We completed the sale of Revolution Bars, which we've been selling down for a while. We were out of Restaurant Group back in March. And the other one that we sold is Air Partner. In all cases, it is not a reflection on the company or the management. It's simply a reflection that I don't know whether these businesses are going to survive and thrive. It's too difficult to call. And I just wanted to protect our capital.
Interesting. And there's been unusually quite a change in the fund's top 10 from January through to March, so just 3 months. I see that AB Dynamics, Focusrite, Dart, NCC and MJ Gleeson have all dropped out. I believe with AB Dynamics, Dart and Focusrite, it's just the share price move that's caused that, and you've been topping up. But what about NCC and MJ Gleeson?
It's exactly the same. It's share price movements that's caused them to drop out. It's not as though we've been selling down the holding or anything. In fact, in the case of Gleeson, we supported the recent equity raise, where they sort of strengthened the balance sheet to get through this. So I don't think the stories have changed much. And as I say, for the most part, the changes have been due to share price movements in both directions. So if you look at our top positions at the end of April, we've had quite a few robust businesses enter into that top 10. Businesses like Experian, like Softcat, Rollins, Bioventix, they've pushed their way in and they've replaced the ones you mentioned, Dart, Focusrite, Gleason, NCC, etc. And as I mentioned, Next, I think, which was up in our top 10 back in January, that's been divested.
Did Provident Financial survive the fallout? When we met last July, you were talking about having got into that earlier that year. Is it still in the portfolio?
Yes, but it doesn't look a very smart investment at the moment. I mean, it's survived the fallout, but it's in a battered and bruised way because its door-to-door collections and home collected credit, that's fallen victim to social distancing. And of course, the FCA has called for debt forbearance in present circumstances, which is hardly conducive to a lender. And the other thing is Moneybarn, which is the car financing business, that's been under the cosh a bit of late from one or two factors. So it's still around, it's still hanging in there, but it seems it's, the play I was making, the recovery I was making has been pushed out to the right again.
And how are you feeling about it?
I feel fairly neutral about it at the moment. I think, I think the market's probably pricing it as being at risk of needing another fundraise. I think if they did that, they'd get it. And this is a business that's been around since 1880 and probably be around in 2080. It's just not been my finest hour, shall we say.
And for the companies that you hold, has COVID created any additional opportunities?
Yes, I mean, I think, the businesses like RM in educational learning and testing, businesses like Softcat in enabling technology, virtual technology, businesses like NCC in cybersecurity, they're likely to be beneficiaries of the move to more online working and virtual conferencing. And as I say, the associated need will be for cybersecurity. So I think those three in particular, I would say, are pretty well placed.
And of the top positions, you've referred to them. Are there any new ones that are in the portfolio, either that appear in the top 10 or that are totally new rather than the top up of the 25 existing positions?
I'm afraid to say no. There were three on the watch list. I think I've probably mentioned in the past that the watch list is typically about 20 companies long. And there were three on that watch list that started to look interesting by the time we got to March the 23rd. But you know what happened after that? The market took off like a Saturn V rocket. I mean, the rebound was so swift and measurable that I'm afraid to say it's taken them all away from my target entry prices.
And when you're buying in to a company that has approached the price that you want to pay, are you looking at the overall market and where it's sitting in terms of support and resistance? Or are you looking at the individual share price of the company itself and how it performs on your IRR model? And it becomes a price that then it stacks up for you to buy into it?
It's the latter. I don't give a monkey's uncle for technical factors and market factors. It's purely a case of, look, what do I think this business is worth based on what I think the cash flows will be from now to Judgment Day? What do I discount that back at? Answer 10%. What does that imply for the intrinsic worth of the business, and what's the market asking me to pay? And if the market's asking me to pay less than I think the business is worth, I'll hit it. I might even hit it if the market's asking me to pay what I think is a fair valuation, if I'm pretty confident about the future of the business and the cash flows. What I certainly wouldn't do is overpay. I wouldn't pay more. If the market was X plus 2 and my valuation's X, I mean, I'd just stick it on the watch list and wait. So it's all about comparing, what you pay in price and what you think you're getting in value.
And you'll carry on buying as it goes down?
Yes. I mean, we would try to establish maybe a 2.5-3% holding straight away if we decide it's a business we like and it's at a reasonable valuation. We just want to get in there and get our holding and then run with it forever and a day. So Yeah, we would buy down, we would average down, much the same as I would. That's my sort of, if you like, my bear market survival tack. What I always do in a bear market is average down, buy more of what I already own. It's almost like pound cost averaging, and you kind of know, you're gonna go out and buy something one week, and the chances are the market will carry on going down, and in a week or 2 weeks' time, you're going to look a bit of a Charlie. But you just have to carry on and say to yourself, no, I'll just buy some more and do that, because you'll never get in at the bottom. The only people who ever get out at the top and in at the bottom are liars, as Bernard Baruch said. And he's right. So, once the market turns, you'll never get in. You'll be scrambling for stock and you'll never get a holding. So you've just got to grin and bear it, bite the bullet. And you kind of know that when you hit that capitulation phase, when, you almost can't bear to put any more money in because you think it's going to go down again and you're going to look stupid. You kind of know then, like, you're getting near the bottom.
Yeah. Yeah. And the amount that you buy is guided by what percentage you want it ultimately to be in the portfolio.
I tend to be pretty agnostic about that. I try to put a certain amount of book cost into each position, and then I just let it run. So if it outperforms, it does a Games Workshop, and it ends up as almost 7% of the fund. If it underperforms, it ends up at the moment like a Trifast, which is sort of 1.5% of the fund. I don't worry about. I certainly would never take profits and rebalance a portfolio to put money in other holdings that perhaps haven't done as well. I'd never do that. I'd probably just direct new money into holdings that have been left behind. But I would never ever pull up the roses to water the weeds.
And how large can any one position in the portfolio be?
It can be up to 10% of the net asset value. So. Above that, we would have to sell down. And also, it's called 5-10-40 rule, and that's referring to the 10. The 5 and the 40 is basically any position that is more than 5% of the portfolio. Those positions together cannot add up to more than 40% of the NAV. So in theory, that's 8. 8 fives is 40, but in practice, it's less than that because some will be over 5. So it's probably more like 6, or if you're lucky, 7.
And how have you found liquidity through the crash? Has it been possible to get in and out of positions?
This is quite ironic, actually. I've found it easier to liquidate than I have to get meaningful lines of stock to top up. And that's a surprise, because I can't help but feel that the thing that's driven the market in this rebound is excess liquidity looking for a home. There are a lot of gamblers out there who like smashed prices, like Revolution Bars or Restaurant Group, and will take a punt on them being survivors and multi-baggers. I mean, they might be right, but equally you might lose all. So punting and trading is not my game. I'm more interested in long-term investing and protecting our capital from permanent loss. So, I've been out there willing to sell things, and some more shall we say, sporty investors in inverted commas have probably been buying my stock.
Yeah. And has the watch list changed as a consequence of COVID-19? Have you now introduced new companies that might benefit from the new world? I know you've referred to that there are 3, but has it actually changed?
Not really. I mean, we're doing a lot of work at the moment on which businesses we think might be winners in the sort of brave new world. But we haven't reached any firm stock-specific conclusions as yet. All I would say is be sure that, the world will be much changed on the other side of this, just like it was after 9/11. So a lot of work going on, but nothing to really sort of hang the hat on as yet.
And just run us through very briefly your investing caveats and any changes to their emphasis that the COVID-19 environment has created.
Well, there's absolutely no change. I mean, the philosophy is the philosophy. It's written in tablets of stone, and it gets tweaked and improved as we go along. But there's never any change of style at all. So, what are we looking for? We're looking for businesses with an economic moat, meaning that they can earn consistently excess returns on their capital without it being competed away to the cost of capital, which incidentally is law of capitalism number 1. If they're able to do that, it follows that they're doing it because they've got barriers to entry. They've got something that's keeping the competitors' tanks off their lawn. We like to know what that is. So we're looking for, I would say, enduring franchises with pricing power. And when we do our research, we're interested in businesses that are engaged in growth industries and maybe where they have the potential for some growth within those markets. So with market share gain and an overall market expansion. We actually prefer steady Eddie compounders, 5, 6, 7, 8% compounders to explosive growth situations, which are A, hard to manage, and B, often get overtaken themselves by a new kid on the block. We think if you've got a growth business, it should be being reflected in expanding operating margins. At the very least, you should be garnering economies of scale and maybe improving your bargaining power with your suppliers. So we would always look for return on sales to be advancing. If it's going backwards or steady, it could be a sign that the economic power of the franchise is waning. But more importantly than return on sales is return on capital. So we are very hung up on businesses that earn high returns on equity. And by high, I mean late teens upwards. Buffettology's got a lot of 20, 30, 40%ers in there. It's got a couple of 60%ers. So return on equity, very important, but it's got to be a cash return. So at the same time, we're really hung up on how much of what you see reported as net income in the P&L account, how much of that is coming out in free cash, because it's free cash that matters to the investor. It's free cash that matters to the company. That's where the money comes from to reinvest in the business or make small acquisitions or pay dividends, et cetera, et cetera. So typically we look at a moving 5-year period, and we want to see businesses that can convert at least 80% of their accounting earnings into free cash flow. We're also quite hung up on strong balance sheets. Something like a half to 2/3 of the companies in Buffettology have either net cash or low single-digit gearing. So financial strength is a big thing to us. We're very concerned about the future. So we like businesses that we think will be around in much the present form, 5, 10, even 20 years down the line. Think Diageo as the great example with its roster of hard liquor brands. That's not a business that's going to change anytime soon or be disrupted away. I don't think teetotalism's about to break out globally anytime soon. So we look at that, and then the last thing is, how does the management behave? Does it behave like an owner of the business, or does it behave like an expensive management consultant? And the way we measure that is rational capital allocation. So we like companies that can reinvest retained earnings to generate future organic growth. That's by far the safest form of growth there is. Love those sort of businesses. That's a big tick. If they can't reinvest meaningful amounts at high returns, then we don't mind bolt-on acquisitions that maybe take you into a new market or new specialization or add some know-how, or there's some synergy benefits. That's rational. We're always very wary of big acquisitions, transformational acquisitions. Tell you more about the CEO's ego than about ability to generate returns for shareholders. And the last thing is, if you're building up surplus capital and you can't find ways to invest it in the business or in acquisitions, then give it back to the shareholders. So we quite like businesses that do special dividends or stock buybacks. And I think the wisdom of that, the wisdom of the strong balance sheet has been proven big style in the last couple of months with what's gone on in the market, with companies having to raise fresh equity to keep themselves alive. So strong balance sheets, I think, is even more important today than it was 2 months ago. So that's really it. And there's been no change to what the emphasis is. There never will be. It's just a case of more of the same.
Very good. And with Games Workshop, you're talking about enjoying a increasing operating margin. Are you not worried that with the reduction in sales, they've got a highly geared operating margin, that's going to be affected over the short term?
Yeah, You're absolutely right. I mean, it's highly operationally leveraged. It's thankfully it's not highly financially leveraged. I mean, businesses that have high financial leverage and operational gearing are the businesses that go to the wall in circumstances like this. But I mean, the thing about games is, yes, it's had to close its stores briefly. Some of them are opening now. Remember, 75% of the sales are made overseas. It's only 25% UK. And bit by bit, as lockdowns ended, they've started to reopen some stores in Scandinavia, for example. And as well as that, they've got their online presence, which is a big thing for them. And really, the nature of their customer, the customer is so dedicated, so devoted to this hobby, that my feeling is, even if they weren't spending now because the stores were closed, they'll be saving it up under the pillow, and they'll go and spend it when the stores reopen. So what I would say to anybody who thinks otherwise is, well, look through this short-term problem we have, look to the longer term. What you must decide is this company a survivor? And if it is, just be prepared to accept that 2020 might be a write-off year for earnings. Doesn't matter. There's not all the value is not in the current year's earnings. In fact, most of the value is in the long-term potential earnings of a business. So that's what we would do. It's great being business perspective investors because we're wired that way, and we can look through this period. The only question we have to ask ourselves is, will this business be around to benefit from when we come out the other side?
Thank you. And I know that Porter's 5 forces analysis is quite important to you. Does any aspect of that become even more important during COVID, or do you think it's the same importance as always for all of them?
I think it's the same importance as always for all of them. There are things there. The 5 forces, for anybody who doesn't know, are the bargaining power of customers, the bargaining power of suppliers, the industry rivalry, the threat of new entrants, and the threat of substitute products. And those will always be there will always be the important parameters, and that's the way whenever we do our analysis, we think about things, not just the company, but the markets that it operates in, and what are the competitors up to. It's a big part of our analysis. It's a very, very robust framework in which to analyze an industry.
And what do you expect for the markets from here? Particularly, do you think they're behaving irrationally with the economic forecasts and actually having recovered pretty well?
I have to say, I can't quite square the bounce that we've seen from March the 23rd with the economic reality. But, remember that adage, never bet against the Fed. And I think that's what's happening. There's so much liquidity being pumped into the system here that's what's holding it up, I think. What do I expect from here? Continuing volatility, I think, in the near term. Where we're headed for market-wise is anybody's guess, really. I just don't do crystal ball gazing. So the market will take care of itself. All I need to do is just concentrate on my investments and making sure that we're getting the best we possibly can to put people's money in.
Brilliant. I'm now going to open up for questions. So we've got James Ridgewell.
Hi, Keith. Well, I've been an investor in the fund for a long time, so fantastic performance. So well done. But given the fact that the fund is now 1.2 billion, I wondered if you could just provide investors with a little more colour about the exposure to smaller companies within the fund. So if you sort of look back through the past, how much contribution or have the smaller caps at the point of investment have provided an outside level contribution to the fantastic performance. So that's one aspect. And then also, if you look at the sort of new investments that you're thinking of making, are they biased? Is the cross section still the same relative to the cross section of market caps within the fund? And also, I mean, I totally get the idea of business perspective investing, and hopefully you never ever have to sell or any of these fantastic businesses for very long periods of time. But if there is a sort of banana skin within the smaller companies, given the size of the fund, and that in some of the companies you may be now sort of top 5 or top 10 shareholder, is there, how do you look at liquidity in terms of being able to get out?
Okay, there's an awful lot there, so forgive me if I miss out parts of it. You'll have to remind me at the end. Right. One of the things that we took a conscious decision to do was to remove our exposure to micro caps. Why? Because you're quite right in saying that, we were 15 to 20% of the company. We owned 15 to 20% of the company. We're not allowed to own more than 20%. So our ability to increase those holdings as the fund grew was being constrained. It was to the point where if the share price of one of the micro caps had doubled, it would hardly move the dial on the share price. Now, the amount of research time spent on small companies is the same as on large companies. Some would argue it's more. So we took a conscious decision about a year ago to start to exit what I call the micro caps, under 100 million market cap. And we're out of them completely now. The 3 companies that went were Driver Group, which we sold the last of just before Christmas. We also, from last summer up to last month, have sold out of Air Partner. And the third one, which we've already mentioned, is Revolution Bars. So those 3 have gone, and we now have no micro caps. We do have a couple of companies whose market caps are between 100 and 200 million. They're currently the smallest in the fund. But really, it is a waterfront now. We have some mega caps in there. By mega caps, I mean more than 10 billion. We have what I call large caps, 1 billion to 10 billion. Our small caps, our mega caps, we say are 500 to 1 billion, and below 500 is what we call our small caps. And it's pretty well equally weighted between those 4 areas. So it's really is pretty broadly spread. In terms of what we're buying when we top up, we're topping everything up. We've maintained our positions in companies that we've been in since day one almost, and we continue to do that. And I would just say that of the current 31 in the portfolio, 14 have been in since inception, plus or minus 3 months. So in other words, from the spring and summer of 2011, 14 of the 31. We have sold out 6 from the early days, and we've lost 3 through acquisitions, mergers and acquisitions. So the actual makeup of the portfolio has not changed that much over this time. We've been buying more of what we already own and sticking to that. In terms of attribution, what's been great? Well, at the moment, the best returner for the fund by quite some miles is Games Workshop, which we've already mentioned. The second best one is actually Liontrust Asset Management, which we started buying at 70 pence in the very early months of the fund. Another couple of our little ones come in at 3 and 4. That's Bioventix and AB Dynamics. But our number 5 attributor is actually London Stock Exchange, and that's only been in a year. And the same is true in the top 10. Experian is in the top 10, as indeed is Rollins. And these are big companies, and they've not been in the portfolio that long. So I'd fall back on saying, all human life is there. And the makeup of the fund is very similar to what it always has been. And I think the same is true of the makeup of the watch list, that, companies like Paypoint and RM, which have joined the portfolio in the last year or so, they've been on the watch list since day one. They're businesses I've known since, the turn of the millennium. And it was a case of waiting for the right time and the right price before we actually pulled the trigger.
I'm going to go over to a typed in question. This is from Nicholas Fox. Crisis brings opportunities which strong companies can exploit. Have you identified any companies companies, which ought to emerge stronger after the virus crisis dies away. Are you looking to take any new holdings in this mould?
Yes, this is back to the question that you asked me, Tamsin. We do think it's going to be a very different environment out there. We do think that there are modes of working that will become more important, and there are companies that are supplying, the necessary software and hardware or something else for that type of business of working. We are looking very carefully for company-specific investments where we think this company is going to come out of this a lot stronger. I mean, I'm not going to divulge, obviously, the things that we are looking at. All I would say is think businesses like Microsoft. Microsoft is going to come out of this as a stronger franchise than it went into it. So yeah, we are looking, and we're not looking at bleeding edge technology, but we are looking more and more at technology enablers, if I can put it that way, that we think will be winners from this situation.
Great. And we've got one from David Collins here. Can you talk about the importance of companies having an obvious moat versus being in growing industries? Some of the companies you sold recently, Revolution Bars, Restaurant Group, did not have obvious moats. Plus, one of your key holdings, Softcat, has a wonderful financial track record and growth prospects, but it doesn't have an obvious moat versus its competitors. The company talks about having the best people, but so does every other company. Your thoughts on that?
I think my thoughts on Softcat are, if you look at the metrics that we look at, return on equity, cash generation, growth, all of it organic, margin development, everything is going in the right direction. It's got a tremendously strong balance sheet. It's come at IPO in 2014. It's come from 9th in its market to 2nd. That to me suggests it does have something special. So I think I would dispute that it doesn't have a moat. It maybe just has a different sort of moat to ones, like Rotork or like Games Workshop or like RWS Holdings. It's a different type of moat, but I certainly think it's got one. So, that's why we invested in it. It just ticked all the boxes. Why did we not invest in it earlier? Answer: we only had a track record going back 3 years pre-IPO. So I think our numbers start at 2011, and I like numbers. I like 10 or 20 years worth of numbers before I can get really confident. So it was one that we watched, and we missed some of the potential there, but I think we're going to be all right with that one.
And Martin McLeod asks, you purchased Craneware for the fund, which has stayed relatively low in comparison with its price for the last year after a few sale issues. Would a software healthcare company like Craneware not be a big beneficiary of current events?
I believe it will. I think our healthcare companies are very well positioned, and that includes Bioventix, and that we also own GlaxoSmithKline, of course. Craneware is an interesting one. I'm just going to give you a little bit of colour on it. 2008 in the States, you probably know I live in the States part of the time. My daughter contracted meningitis and was hospitalized for 4 days. And they were using, as it turned out, Craneware software. And I was watching them, and I was thinking, this looks really interesting. This doesn't happen in NHS hospitals. What's going on here? And I asked them, I interrogated them, and of course, nobody knew. And then, almost by accident, when Rosemary was working with us, she said, have you ever looked at a company called Craneware? And I said, no, what does it do? And she started to describe what it did. And it was like that light bulb moment, ping. And I looked at it, and I couldn't believe what a robust business it is. And it's definitely in the right space in the US hospital market. I think it will be a beneficiary from the Brave New World.
And from Stephen Marcus, quick question. Are you steering away from any particular sectors at the moment? And have you been influenced by the crisis to shift at all?
Absolutely. I mean, this is what I was talking about earlier. Anything that's directly facing the consumer is really, it's almost on death row at the moment. So we cleared out of everything in the retail sector. We cleared out of virtually all of our travel and leisure businesses because I'm just concerned that we might have ended up with permanent loss of capital. So without a doubt, I mean, we've definitely responded to what's happened in the last 2 months in terms of clearing out businesses that I think are at serious risk of not coming through this.
And from David Beggs, what were your main takeaways from the Berkshire Hathaway AGM last weekend?
That Warren Buffett was not the man who made the investments in the airlines. I think it was probably Ted and Todd. I don't know that for a fact, but I think it probably was. And I think they probably put some of the portfolio into Apple as well. The other interesting thing was on the succession, I thought, and that Greg Abel is very clearly going to be the operating subsidiaries head when Warren and Charlie shuffle off the mortal coil. And the other thing was the reference to Todd and Ted as being the people who would be the investment managers. There was no mention at all of Ajit Jain, which I thought was slightly strange. And of course, he wasn't there either. It was Greg Abel and Warren who did it. So I think that. I think the other thing is, because I believe this very firmly, don't bet against America. That was the other, I think, big message I took from that. But I think the succession planning was probably the big insight that I got into, where that business is going.
And Charlie Hollenrake, who was trying to ask his question by phone, has now come through here and asks, if you were writing your book, would you make any changes to it? So if you were rewriting it, would you make any changes to it?
Yes, I probably would, Charlie. I think chapter 7, where I was talking about predictability and certainty, as you know, I chose to use the funeral services industry as an industry that's very predictable in terms of demand. I went a little bit too far with stretching it to a company involved, which was Dignity, which, as we all know, has been disrupted since by online price comparison websites. So I think I would make a change there. I would probably still keep funeral services as being a very predictable industry, because I genuinely believe that, having not just owned businesses in it, but followed it as well. I would just loosen the linkage with any particular company serving it, when you get down to the micro level. But there we go.
And David Beggs asks, how are you dealing with the growing divergence between the valuations of quality companies and the rest of the market?
Yeah, good question, David. It's it is a fact that, at the moment, anything that's perceived as being a survivor and in a good position is trading at really quite an expensive valuation relative to businesses that perhaps don't look quite so robust. So how am I dealing with it? I'm trying to keep our weightings up to the various companies in the portfolio, but there's one or two that they really have just perhaps gone a little bit too far. I'm sat here just hoping we get another pullback. Let's have another March 23rd, please, and then I can get even more capital deployed.
Paul Hawkins says, fascinating insight, thank you. On your point, remanagement and capital allocation, what metrics do you use to judge their performance on? Or is it more a case of looking at the cost base expenses as a measure of not thinking like an owner?
What I like to look at is I like to look at marginal returns. I like to look at the incremental return on equity over 1, 2, 3, 4, and 5 years. And I like to see, have they been able to invest meaningful amounts of capital at returns that stack up against what the historic returns are? So the return on average equity is the historical scorecard of the return on the historic stock of capital. I like to take chunks over 1 year, 2 years, 3 years, 4 years, 5 years, as I say, and look at how those returns are stacking up, because sure as eggs are eggs, if the incremental return is in excess of the average return, they are finding projects to invest in that are firing like the old projects did. This is something I mentioned earlier, that Charlie Munger and Warren Buffett and Jeremy Utton and I had this short meeting over in Omaha, and this is one of the things that Charlie Munger really did sort of reflect on to me. He said, you should watch the incrementals like a hawk. They tell you what's going on. You can't do it over just 1 year because, best will in the world, companies are not set up to perform on 1 year, 12-month intervals. It just happens that to be the accounting period. Projects can sometimes take time to build and fire. And by looking at the incremental returns in bite-sized chunks over, as I say, 1 to 5 years, you can see that happening. And then the next thing you have to look at is, well, how much of retained earnings were they actually able to invest? Because obviously the return is the total return is the incremental return times the amount of capital. So ideally, you want a high incremental return and the ability to fire hose large amounts of capital into the business. So that's what I really look at there, incremental returns.
Great. And Imran Khan asks, what do you think of Scapa these days? I know you bought more when they crashed last time also, and somebody else asked this question as well.
Yeah, we had bought more of Scapa. We've bought more since it's fallen down again. Scapa's it's an unfortunate case in a way that they built this big factory in Knoxville, state-of-the-art factory, Knoxville, Tennessee, and the base contract that was for was Convatec. And when they then bought the Gargrave facility over here, Convatec claimed that infringed the terms of their agreement with Scapa, because it was obviously Scapa were dealing with competitors. So that's what led to the big problem with the lawsuit against Scapa, which was thrown out, incidentally, in New Jersey. There's now a lawsuit the other way, Scapa against them. I think it's being heard in Connecticut, but don't hold your breath for any swift resolution. The wheels of the law run very slowly. But it's a shame that happened. And it's a shame also it happened at a time just after He-Jae Choi had announced that he was going to retire from the business. And He-Jae's thinking was that he had one good job left in him. He'd just turned 50, had one good job left in him, and he wanted to do something else other than what he'd done for the last 10 years. The result of the Convatec situation was that He-Jae had to come back. We and two of the large holders, US holders of Scapa, were instrumental in persuading him to stay on. And of course, now we've got this COVID-19 situation. He must be sticking pins in images of me, I think. But so it's one. I like the business. The future is clearly the healthcare side. Will they divest the industrial side? I suspect that's the intention ultimately, but I've got to remind you, the industrial side still is the bigger of the two. So I think it's a case of, stick with it, but don't expect fireworks in the short run.
And Andy Rome asks, how do you view a change of approach to supply chain management, i.e. a moving away from efficiency to resilience, will affect companies like Trifast and Morgan Advanced Materials?
Yeah, I don't know Morgan Advanced that well. I mean, I know it's held in free spirit, but it's one that Andrew knows better than I do. What I can say is you're absolutely spot on about, Trifast is a business that just in time manufacturing and supply chain has been very important to. I think it will end up where resilience perhaps plays a bigger part than pure efficiency on the part of manufacturers. I find it very difficult to call what that will imply for Trifast on its own. But I do think I accept the premise of your argument. And therefore, I wouldn't have thought that was necessarily a bad thing for component suppliers. It probably just means that this whole single sourcing model does go out of the window. Now, how you do that when you're making special fasteners like Trifast, as these are not bog standard nuts and bolts. These are engineered to a precise plan to precise specification. How you do that with a second supplier, I don't know. I mean, I don't know how Nissan and people like that would do. So I do think there is some resilience argument to be had there, but I don't see it affecting anything of the sort of specials, custom built stuff that's made in the supply chain.
And Macy asks, what do you see as the durable economic moat in Liontrust asset management? Simple.
It's people. It's got better fund managers than most. It's also got a great culture. I will say this. I mean, Sanford Deland has got a fantastic culture, and we all believe, culture eats strategy for breakfast. Liontrust has got a similar, very, very strong culture. It's got managers who perform. It's got managers who are incentivized. They have their own P&Ls, so they're incentivized to get the best returns for the investors. And I can see an awful lot of SDL in Liontrust and vice versa, and the performance of its funds is great. The economic advantage model is not a million miles away from business perspective investing, so there's an awful lot of kindred spirit there.
And Benjamin Dyson asks, how do you balance your time between managing the portfolio and keeping an eye on the watch list? Is this set up to price alerts or something that you and Andrew just dip in and out of?
It's more the latter, and indeed Eric. We all keep an eye on things. We revisit things. I will keep my financial spreadsheets kept up to date, 6-monthly intervals. I'll occasionally dip back into something if I think it's looking interesting. It really is a case of constant monitoring and sort of nurturing of the portfolio and the potential portfolio, if I can put it that way. So I would say I probably spend about 5 days a year on research on any individual company. So you can see why I don't ever want to have more than 35 companies in the portfolio. I just couldn't handle it. I don't have the time. I don't have the bandwidth, and I think I'd be at risk of maybe missing opportunities. So that has to be balanced against marketing. That takes up quite an amount of time. I also, as you know, I've passed over the operational aspect of the business now to Alex Brotherston, who's our CEO. That was a conscious decision on my part that I had to choose between investment side and general management of the business. I thought better, my forte is really the investment side. I've set the business up, I've run it, and now somebody else is doing a far better job than I ever was with it.
And Nicholas Fox asks, has the portfolio suffered from redemptions, and were you forced to make any disposals?
To the latter, no. Mainly because we have had a decent buffer of cash all the time. In terms of redemptions, April, we had a net outflow of, I think it was just 5 million there or thereabouts. And the reason for that was the biggest holder sold down more than half of their holding on a rebalancing exercise. Prior to that, the last month at which we had net outflows was August 2015. We've had net inflows all the way. So April, May could well be an out month, net out, because this rebalancing exercise straddled across the end of April and into May. But in general, no, our holders are staying remarkably loyal.
Keith, I'm afraid that's all we've got time for, but do tell our audience where they can find you and more about Sanford Deland's Buffettology Fund.
www.sanford-deland.com. We do put an awful lot of stuff on our website. Doubtless this webcast will be appearing on there at some point.
Great. Thank you very much indeed for your time.
Thank you, everybody, for your time.
If you want an email notification of webinars or events we're organising, please sign up for events on the right-hand side of the homepage at PIWORLD. There are 2 boxes. On the top, sign up for notifications of a new video as it's published. The second down, sign up for events, different lists, no spam. And please do tell your investing friends about PI World and write comments or like our videos on Twitter, bulletin boards and YouTube. We'd like to go on providing these free webinars, and getting good speakers relies on the audience number we attract. Many thanks to you all for joining us, and stay well.